Well, joining us now with some tips to set your portfolio up for success is Adam Phillips, EP Wealth Advisors Managing Director of Portfolio Strategy. Thank you for joining me this morning. So, we're seeing how equities have been faring so far this year. A lot of people wondering, though, what are the red flags we should be looking for when you do have this concentration trade among these mega caps?
I think that's a great question. We're talking about the fact that breadth in the market is so weak right now. You look at the S&P 500 up about a little more than 11% this year, up now about 20% off of the October low. And so that's what we're talking about with our clients, and the fact that breadth is low. And really, we're not buying into this just yet. We may be on the cusp of a new bull market here, but I think this bull market really deserves an asterisk until we see some broader participation. And right now, we're just not seeing it. And so what we're telling our clients is to just remain positioned for some additional volatility and downside volatility from here.
So then, as you look at the broader equities market, then what are you honing in on?
Sure. Well, we're looking at some of those players outside of the technology space. Obviously, AI has really driven a lot of the strength there with those large mega cap companies, but we want to see broader participation outside of that. Right now, we are defensively positioned across our portfolios, so we still have an overweight allocation to the energy sector. It's an area that we feel has been rather unloved for a while. It was a source of outperformance last year and has taken a bit of a breather this year. And we still think that there's some opportunity there, also focused on healthcare. But I'd say the theme across our portfolios is really one of defense. And what we're waiting on, I would say, before getting a little bit more optimistic or bullish in our outlook is just some additional signs of strength in the market. Broader market participation, more stocks trading above their 200-day moving averages. And so until we see that, I think we're going to maintain more of a cautious view.
And it can be hard not to buy into a lot of this hype. Pretty much on almost every earnings call, you heard AI mentioned, even if you didn't really get the details of how we'd actually see the use cases for some of this technology. And you expect earnings to actually be revised down in the upcoming quarter. How should people be positioning their portfolios so that they can try and take advantage of some of these AI companies that do have some legs and some of the ones that they should perhaps be more cautious on?
Well, when you talk about AI, I think it's so interesting because, this is a theme that is going to take years to play out. We won't know for quite some time whether it really is as revolutionary as many are hoping. And so I think it means it's going to be tough to pick a winner. I think if people want to play that theme, you want to focus on diversification as opposed to choosing that one winning horse. Within our portfolios, we are we do have exposure to some of those larger names that are often discussed, some of those that have been more of the high-flying names. But, I'd say that right now we are mindful that some of these companies we've seen their valuations really explode here. And so, as far as being a good entry point, we'd be a little bit more cautious here. That's why we're not adding to it. What we are more focused on within our portfolios is diversification. So with our clients, we're really just preaching about diversification. It's so easy to become enamored with today's leading story, which is really AI. And I think many would look to the recent winners and look at, you look at a company like NVIDIA recently joined the $1 trillion market cap club. I think, many will worry that they're missing out on something. And so what we're trying to educate our clients about is that history has proven time and time again that it's about diversifying your portfolio. It's okay to have some exposure to some of those names that may be the beneficiaries of that theme, but don't forget about the rest of the market, because that really is just a small subset of the broader market.
And what do you see as some of the biggest risks to the S&P in the back half of the year? We talked about the pain trade potentially of AI if you get overly excited about something that may not pan out. But you also have the ECB and the Reserve Bank of Australia also saying, look, we might have some more rate hikes ahead as well, and maybe gauging what the US Fed might do.
I think the Fed is still incredibly important. We're focused on a number of topics. Now that we have the debt ceiling behind us, I think it's just back to the basics that we've been living with for some time now, and that's the Fed and the inflationary outlook. We are going to be watching China and U.S. relations very, very closely. Next week we have the FOMC meeting, the June meeting, and we believe that the Fed is likely to pause. I think what we're going to be interested in is whether they signal a pause or I guess what we would call a skip, whether they're going to provide language implying that this is not a pause in which the next move would be a cut in rates, but whether they're actually going to just take this meeting off, wait for some more information before proceeding with possibly additional rate hikes in the July meeting. And so I think there's a lot for us to remain focused on. One of the things that you did bring up that we're watching very, very closely is the earnings outlook. So far, it's holding up. I'd say earnings have proven more resilient than we would have expected, but we still believe that they projections are likely to move lower as time goes on here, and analysts and corporations start to I'd say realize some of the pressures that they're up against.
Especially if we do get that skip versus a pause. Thank you for bringing that up. Interesting context there. Big thank you there. Adam Phillips, EP Wealth Advisors, Managing Director of Portfolio Strategy. Thank you for your time this morning.